So index rebalancing, we'll talk about rebalancing, right? So this Nifty 50, there are top 50 companies, and these 50 companies will be performing good or bad based on their management, market environment, countries, what is happening in country. Based on that, these 50 company will be performing good or bad, or like getting some business, and their return growth will be there. So SEBI, or like not SEBI, NSE, stock exchange, what they do, they will be keep on monitoring. Okay, is this index is the representation of our overall country's economy, right? So everyone will be monitoring this index in Nifty 50 and no Sensex. Even government, RBI, SEBI, everyone will be monitoring it, because FIIs and DIS, foreign countries, right? They invest in the no country based on, or looking into these indexes. There, that will be their primary focus area, right? How country is doing. So everyone, government, RBI, SEBI, everyone will be monitoring, and it is important to like be very clean and very balanced and accurate about this index. So what exchanges do, NSE and BSE do, they every 6 months they will be monitoring and rebalancing these companies. So whichever company is doing good, they will keep it continue, and whichever the last one or two companies which are not doing good, they will remove it out. Okay, and they do every 6 months. So whatever bottom performer of those 50 companies, they will remove one or two companies, and whatever good performer, they will continue. And what they will do, they will remove low performing companies, and they will bring the new companies. Okay, so when I had created this PPT, that time Naukri and Apollo hospitals were in the list of coming into the Nifty 50, and Coal India and India IOC has been no supposed to be go out. So if you see now index fund, those 50 company, this no Coal India and IOC will not be there. Both or either of these will not be there, and Naukri is there in the index now. Apollo hospital, I need to check whether it is there or not, and Naukri is there. So this rebalancing happens every 6 months. First once happened in March, another happened in 30th. Okay, and which are the companies going in and which are the companies going out, that you will get around that time in the news, 1 month, 2 months before. Okay, other thing is that when we put money in the index fund, right, our companies are automatically monitored. We don't have to monitor, you see that, right? So what they will do, suppose you have put some 50,000 in Nifty 50 index fund. So whenever these companies are going out, so first they will be putting your 50,000 in equal ratio in all these companies, right? Whatever they're in 50 company in the index. Suppose now Coal India is out, so they have invested some money in the Coal India. So what fund manager will do? They will sell all the shares of Coal India, and they will buy again to the Naukri.com. So that is how your fund is automatically managed, or your stocks are actively monitored. So these are fine, no top five fine companies, which is always scrutinized and audited. So if you are putting your money in these companies, there is high chance that no you will be getting good return or equal return of Nifty 50, and you don't have to monitor it every now and then. You can just do SIP over there. Okay, so and this rebalancing, as I said, two times it happens, March and September, and you will be getting in the news around that time which are the companies supposed to be go in the market and which are the companies supposed to be come out. So other thing are trading. If you are thinking in the terms of short term or swing trading, what you can do is as soon as you get the news, uh, which company is going into the Nifty 50 index, you can put money in that particular company, because as soon as it will go to the index, be part of index, those companies will get the money, right? Fund will come, so automatically their price will go up. Okay, or these are good company, even though like you waited on this company and put money and they didn't go to the index, for temporary basis it may go down, but obviously these are considered for the index, means that these are good company, and they will grow over the period of time. So obviously you will get return whether that company goes into the index or not. Okay, so let's see what are the criteria for no going into the index for any company. So I have listed down, there are 6 criteria. Okay, these are the selection criteria for any company to go in index Nifty 50. So first thing is that that company should be doing business in India, and it should be listed in the Indian market. Okay, obviously without that it cannot be part of Nifty 50. Then minimum 10% of the company shares should be available for as a free float market cap. In the beginning only I told, right, we decide Nifty 50 companies based on the free float market cap. What is free flat market cap? Like what are the number of shares, what percentage of number of shares are available for the public to trade. Normally 75% max promoter can have, rest of the things should be available to the market for trading. So minimum 10% should be available for the public to trade is a free float. Then the company should exhibit a sufficient liquidity. So all the company should be having enough liquidity, right? It should not be touching the everyday that upper circuit, lower circuit. So it should have enough liquidity. Then how they consider which company should be bring and which company should be out. Other criteria is that suppose one company they are planning that okay, this is not performing good, this company should be out, and their market cap is 18,000. So the company which they are bringing in to the index that should have a market cap of 1.5 times of outgoing company. So if this company is going out, ABC Limited is going out, and it has market cap. Market cap is nothing but your number of shares, available for trade into price, current market price. And here they consider average, okay, average number of share and average current market price. So this should be more than 18,000 crore. Okay, this is like sorry, that outgoing company. Suppose outgoing company have 18,000 market cap, then incoming company should have one more than 1.5 times of outgoing company. That is 27,000 crore. And if you say 18,000 plus 27,000, that is 45,000. So incoming company will have market cap of 45,000 crore. Okay, and total market cap of incoming company should be more than 20,000. That is other six criteria, and it should be FNO category. Its future and options should be available. There are a lot of companies whose market cap is bigger than this, but they are not considered for Nifty 50 because they are not in the FNO category. Like your DMart have a larger market cap and it is fulfilling all the criteria except that FNO. FNO only like though there are more than 7,000 companies, only 200 around 200 companies are there available for FNO category, where you can do future and options. You can buy and sell. There are no CNP that segment. Okay. So hope you understand this, how companies are selected for Nifty 50. They should be doing business in India. That they're like no, they should be listed in the market, particular exchange, NSE or BSE. Then 10% minimum 10% of their shares should be available for the public to trade. Then companies should have enough liquidity. It should not be hitting every now and then upper circuit, lower circuit. Their market cap should be more than 20,000 crore. They should be in FNO category, future and options. And like this is the calculation for ingoing, outgoing companies. Okay. So with this, we understand how companies are selected for our Nifty 50 index. And our in India, we follow free float market cap method for considering any company for index. So consider that one company was having 20,000 crores market cap, and it came down. Market price, share price has come down, so its market cap has gone down to 18,000. So it is automatically, it is not fulfilling the condition of more than 20,000. So they will kick it out. So this is how automatically it get rebalanced. And that is the advantage that if you are putting our money in the index fund, it is automatically monitored by everyone. So you don't have to monitor actively. And you will be rest assured that only the good company, your money will be going all the good companies. So I will tell you one nice story, which is no, from the Peter Lynch books. So what they did, once they in the seventh, they took the seventh standard students and asked them to select some companies, and no, they were given some money. If you have this money, say this much amount money, which company you will put the this your money for growth. Okay. So what this seventh standard student did, they selected different companies, and their portfolio gave 76% return in 1990 to 1991. In 2 years, these companies gave 76%. And at the same time, all those mutual funds, right? Different experts, mutual funds, their portfolio gave only 26%. So basically, these students, seventh standard students, portfolio gave three times more than the experts, and everyone was surprised. What? So when this guy, Peter Lynch is Fidelity manager. He has a lot of book returns. So when he came to know about this, He called all those students and teacher and asked them, oh no, how you selected your company. So before selecting the company, their teacher had given them three instructions. First, whichever company you should select, you should know what that company does. First thing. So what they did, they selected only the companies which they used in their day-to-day life, like Coca-Cola, then no McDowell's, and then their IT companies, are their pencil and no notebooks, which company makes those kind of day-to-day life, right? Whatever they use in day-to-day life, only they were aware about those companies, right? So they selected those company, and they know like what this company does, like McDowell's. So they know that McDowell, say no sells the pizza, those French fries and other things, right? So this question helped them. Then their teacher asks, why did you select the company? They need to say why they have selected the company, that particular company. Second question. Then third question they were asked is assignment. Like whenever you select the company, you need to read about that company, what's happening in that company, and what is news about that company. So they were asked these three questions. Simple question: what company does, why they have selected the company, and if they want no to continue in that company, they should know the news of that company. And if we do these simple things, three things, we can make enough money. We don't have to be expert. We don't have to go around no multi-bagger and all. If you follow this simple rule and stay invested for long term with the discipline, we can make good return. Okay, and this is there in the Peter Lynch's book, Learn to Earn. So this is the fidelity manager. Then this so before you like no select any company, you can consider these questions. Maybe you can take the notepad and write these questions a little bit about this. You can get all the details about this company in your demat accounts. There will be like fundamental section there, you can get the now. Most of us pick our shares or select our stocks based on some suggestions. Maybe I will be telling you buy this company, DMart is good company, S&P is good company, you will be buying that. Or some friends will be telling you, or those SMS will be coming, right? This is good company, this is bad company, this will go up, this will go down. But most of us, either we follow that news or YouTube or some our person who we believe that this person knows about the stock market, and we based on that advice we follow the no uh, invest our money or follow our investment. But I will tell you one quick thing, 1 or 2 minutes, not even 2 minutes, just 30 seconds rule or action you can take, and you can select whether you should invest in that or not. Okay. So first thing you should do, if you anyone is telling you like buy this company or sell this company, what you do, and I'm talking about long term perspective, right? I'm not telling that about trading as perspective that you buy today and sell tomorrow. That is different strategy. So NAC, just Google, you can do in the even in your normal mobile or laptop, whatever. Say I want to see TCS, NAC TCS price. So you select that, Google that, and what you do, you simply go to the max chart and say what is the graph. If graph is bottom to top like this, okay, I will turn on video to show. So if graph is like this, bottom to up, going this way, you can go and invest. Even though not today, maybe like after few days, it will give you return. So you should always go for this kind of company, whose graph is bottom is down and top is up. Okay. So TCS you can see, right? Let me give you another example. Aditya Birla Capital. I have taken. You can see, let's say Jet Airways, Jet Airways India. Max graph. See how is its graph? Bottom to top to bottom. So if you are anyone is suggesting you any company, buy this or that, you should consider checking their max graph. Okay, how they are performing. So would you like to go for this kind of company? No, right? It has been trading around 1300, 1350. Now it is trading around 4 5 rupees something, 50 rupees. Okay, so never go this kind of companies. And in this kind of companies, operator will be active. It will be taking no stock up like this, and lot of retail investor will be coming. Then they will dump that stock, and you will lose a lot of money. So just 30 second, 1 minute time you spend, check the graph. Then you decide whether you want to do or not. Max. You just search the stock in Google, NAC, stock price or share price, and their max graph. Okay. So this kind of company whose graph is going from bottom to top, this kind of company is called growth stocks. And these are like basically this kind of company is basically where your value destroyer, right? Then there is another category of company whose graph will be like this, up and down, up and down, like that. Like no mountain, it will be up and down, like triangle will be making. And this kind of company is called cyclic, no cyclic or cyclic, no companies. So if you see Jan Irrigation, JHS is seven guard, right? JHS seven guard, JHS seven guard. Again, this is going to end in 10 minutes, so we will take a break after. I don't know, time passes so fast. Okay, so if you see, right, it's going up, down, up, down, up, down. So this is cyclic company. This kind of company we should avoid. Otherwise, you should be smart enough to know which is bottom and which is top, like when to entry, when to exit. Then only you can make the money. So in the beginning, at least, we should avoid this kind of company whose graph is either going down, top to down, or the company which are cyclic. Other good thing in the this Google Finance, right? What you can do here, once you search, let's say any company we can search, we want to see whether we should buy Asian Paint or Berger Paint. So you simply type NSC, Asian Paint. NEC, Asian Paint. I will go and I will go max graph. Okay, and there is option to compare. So I can do Berger Paint and I can put max graph. So you see that Berger Paint is showing more growth, more no returns in max turn. So you can check 5 years. You see they are almost returning same. Sometimes Asian Paint is up, sometimes Berger Paint is up. Other thing you can do is you can compare with the Nifty 50. So any company, our ultimate goal is what? Beating the Nifty 50, right? If you want to get the same return as Nifty 50, then we can go and put our money in the Nifty 50. Our ultimate goal as an investor, or when we are doing the putting effort and time, our ultimate goal is to gain more return than Nifty 50 and beat the inflation. Okay. So you can compare with this. If any company is not giving more than this blue line, right? Nifty 50, you can avoid. So this is how you can compare different companies. If you want to decide whether this company should I go, this company I should go, then you can check their max graph, then 5 years graph, 1 year graph, how they are performing, right? Other strategy, there could be different strategy. Like say Asian Paint is great company, all the fundamentals are very great. But for some reason, because of external reason, not the company reason, because of some external reason, like crude price has gone up, or this Ukraine Russia war happened, then this great company is available below like Nifty 50, right? Return. It is not giving great return at this time and its price is less. Invest at that time so that you get higher return at later time, right? Basically now it is available at cheap. If you know already every fundamental and everything is good. So this is how you can use simple techniques. We will learn more and different no parameters to check the stock, but these are quick tips which you can follow. You can check their graphs, you can compare with the Nifty 50 and then decide whether you want to invest or not.